Welcome to the Long-Term Investor. Jamie Catherwood is joining me today. Jamie, thanks so much for being here on the show.
Thank you so much for having me. Excited to do this.
Well, I reached out to you in response to one of your posts for Investor Amnesia, one of the best, if not the only, maybe, you tell me, financial history websites out there. You kind of came exploding onto the scene with a passion for writing about history in general. So I think that's a great place to kick us off. How did you come to start writing about financial history?
Yeah, so I guess that intro is perfect because it captures the very fortuitous circumstances that I kind of started writing in, because history is my passion. It's always been since I was a kid. My family on both sides has a lot of either actual historians or everyone's interested in history. So that was always kind of around me growing up. But I was very lucky when I kind of got into the Twitter sphere and financial Twitter in particular, that there was no website dedicated to only financial history. So that was very convenient for me. But I went to school in London, in the UK. I went to King's College London, did history. And then I knew I didn't want to go into academia or something like that after graduating. But my dad's philosophy was, if you think you're going to get an MBA, then do something not business related undergrad to kind of round you out. And you don't have to do the same kind of material twice if you're going to do business undergrad and MBA. So right or wrong, that's what I did. I think that it was a great approach. So I did history. And history, I think, is a great subject because people tend to think of history as the same level as kind of high school, maybe, or like elementary school, where it feels like a lot of just remembering names and dates, and like that's the whole discipline. But obviously there's much more than that. And the skill set that I think it gives you is very applicable across basically all industries. Because if you think about what history it is just taking sources, whether that be primary resources, so you're actually like looking at archival documents, or secondary sources, so classic books like JSTOR articles, etc. And then you're just taking all that information, pulling out what you think is important, and synthesizing that down into a new format, usually like an article or something, and using all that information to kind of come up with your own argument and try and convince someone else of it. So obviously those skills are useful in every industry. It's just what the inputs are. So like at O'Shaughnessy Asset Management, a lot of what I do is writing and putting together content. And it's, to me, the same process. It's just different inputs. So instead of, reading about, the creation of Palestine as a state in the early 1900s under British rule, it's, here's what our factor scores for the fourth quarter last year. Like, here's what decile shareholder yield is trading at right now. And then taking that information and putting it into an article or white paper that helps communicate our firm's views to clients. And so, long-winded way of saying, after I got into Twitter and saw that there were a lot of people posting great content, podcasts, blogs, etc., financial history was the subject that seemed most fitting for me because it merged my two interests. But I didn't know there was like this, huge financial history field when I was in college. I took some economic history courses, but those honestly were, one of them was interesting. It was on the interwar German economy, so like the whole Weimar inflation period. But another was on British economic history since like the 1700s, and it was, talking about the productive ways to grow corn and stuff like that, and how that changed like the Sheffield economy. It's like, this is astronomically like boring. And so when I graduated, though, I thought, there's probably some history of finance, like interesting characters or whatever. And I originally planned on it being like a 5-article series or something, just mainly because I missed writing. I like kind of researching and writing essays, and there was no reason to do that anymore after I graduated. And so this provided a reason. And then to my surprise, people were very interested in it because I think history is something that a lot of great investment writers talk about, like Morgan Housel, Jason Zweig, et cetera. Like, Jason Zweig knows more about financial history than I ever could. But they are not exclusively writing about that. And so it was just very lucky for me that basically like Neil Ferguson was my only competition and there's no competition there. And so it's kind of like, you know, I'll be the poor man's Neil Ferguson. So it went from writing some articles on Medium to then launching my own website, investoramnesia.com, because we never learn from the past. And then also launching a newsletter, online courses, and that brings us to now.
Well, I appreciate all that background. And one of the things that you find in a lot of the investing classic books is some sort of review of history. As your website says, the tagline, "We've been here before." What is it that makes a solid understanding of history so important to successful investing?
I think it just really helps you. I mean, it's obvious, but I think it's important. It just puts everything in context, you know? And so when there's a new innovation that is allegedly going to change the world, you know, not to say that every time that happens, it's just like you're some grumpy, you know, history nerd saying, you know, this like failed before, so nothing's ever going to work. But I think it does give you just some perspective when everybody's saying this is going to change everything, you know, like invest now, blah, blah. When you've read about so many like manias and crazes and bubbles throughout history and almost always related to some hot new thing that's going to change the world, you kind of get just more appreciation for, or I guess you get less swept up by the hype because you've seen similar versions of the same story before. And so I think it helps you not just get carried away with the, you know, general excitement in the media, other investors, et cetera. So like NFTs, for example, not to say anything about the long-term viability of NFTs. I feel like there's probably something there. But when there was that real just craze during COVID lockdown, I was thinking the JPEG rocks, like, that is a situation where you can just think, I can think of like 4 examples, you know, of similar things in history and know how that ended. And so it's just kind of what are the odds that these insanely high prices are going to only continue rising, or what's the odds that these insanely high prices for a JPEG of a rock are going to go down? Like, and so I think it's helpful with that stuff. And again, just kind of, one of the things I actually didn't think about that Jim Chanos talks about in his course at Yale on the history of financial market fraud is that history also teaches you a valuable skill set, which is going to the source material. So again, obviously you'll use secondary sources in a lot of situations, but the kind of, once you get to the real like academic level, when those papers are being written, they're doing the original kind of archival work. And so I think it just helps you become better at determining your own views and coming up with your own kind of thoughts on a topic or situation from the actual source material instead of relying on secondary opinions, which I think is very valuable, especially for investing. You look at the 10K and then come up with your opinions instead of even reading only everyone else's opinions about a company's like 10K or, you know, whatever. So I think that's a valuable skill.
You know, you mentioned something about not getting swept up in crazes. And I think a lot of times it's common to hear that greed and fear fuel a lot of investor actions. In a, what I'll just call throughout a normal cycle, greed doesn't always show up unless there is a craze. And fear mostly shows up when there are downturns, which are pretty regular. And so I think, you know, at least as an advisor myself, I often find myself setting expectations and using history to help prevent fear for when inevitably there are bad times. With greed, you're telling stories, and those stories sound so ridiculous that if I were to share those with each client, they would probably say, well, gosh, that was obviously nuts. But you're right. Every time it seems like the world is going to change, gets everybody's all emotions and they don't want to miss out. And I think what a lot of people miss there is that you can have something that changes the world and also have it be a poor investment. growth and returns just not really absolutely tied at the hip. And so I appreciate you kind of sharing that. And the other thing I think that sometimes I find helpful with history is it just gives you appreciation for where we are today and how good we have it. And a little bit of what prompted me to reach out to you, invite you on the show, is when you put together an article, which I'll surely link to in the show notes at thelongterminvestor.com, just on the history of investment vehicles and how far we have come. And so I would love to give you the stage here and walk us through a little bit of how people used to invest and how we have developed to a place of such high customization and individualization over time. Sure.
Yeah. I before I go into that, I just want to
That makes me
say,
feel
'cause you
too old
reminded
if the
me,
90s are
before we
history.
transitioned. I think one of the important things to
That's
remember
right.
also with
Yes.
history is that
Yes.
we always tend to view ourselves as superior, I feel like, to people in history. And when I say history, I mean, I'm like, if you're going back to like the 30s and before, not histories in like the 90s. And
We have more data. Yeah.
well, I guess like technically, anything is history that's not right now or in the future. But I feel like we always tend to view ourselves as smarter, which obviously to a certain extent we are, but not even really smarter. It's just that we have more, we know more because of, yeah, exactly. And so I don't think it's that we're naturally smarter. But so when we look back at these bubbles, it's almost like, yeah, that they were crazy then, but I don't know how this is really applicable today because obviously we would never make that type of mistake. And it's like you would, I look at the last 2 years. And so I think that's important for people to remember is you, not that, you would have been one of those idiots, but like have an appreciation that it's not a given that you would be so
And you're
smart
like,
to
what if
recognize
it is the
this
next
is
thing
a
and I miss
bubble and
out on
not
this
some
opportunity to
world-changing
become
innovation?
rich and my
Because
neighbor is
I'm
doing it
sure
and my,
in some of the
the
recent
dad at
ones,
carpool
like
that I keep seeing is
every
doing it.
investor has at least
Yeah, it's tough, but we're
contemplated because
working
it's
with the
hard,
same
just human
hardware and
behavior when you
wetware
see
that
all
we
these
were
prices going
hundreds of
up.
thousands of years
And even
ago.
if you think it's
And our
stupid, part of
silly
your brain is
brains
like,
just
buy it,
love
buy it.
good stories.
And so,
Whereas, again, I think the most
yeah,
important thing in
yeah,
a craze is earth-shaking greatest idea
yeah,
doesn't necessarily mean good returns. Price that
exactly.
you pay matters a ton, and if you pay too much for anything, it's ultimately going to have lackluster results. With crypto, it's a lot easier to say with the FTX blow up, and I think kind of near the back end of the episode, I do want to touch on this a little bit more. But it's easy even with a blow up to say, well, yeah, obviously all that crypto stuff, the NFT stuff was a mess. And I feel like I was pretty regularly publishing on the intellectual side of it and being like, yeah, I don't really recommend this, but if you do it, here's what you should do. I kept hedging my bets because I might have been wrong. But there were things that did seem silly, like buying pictures of rocks or, the bored apes. Look, my kid just bought a $50 box of baseball cards. He pulled a card that is allegedly worth $150. My instinct was, well, go sell it because who the heck is actually going to buy $150 for this baseball card of a minor league prospect who may or may not pan out? And I think that's one of those things that like you kind of the money seems real, and then once the money's up, you're like, well, no, I'm going to hold it because the world is changing. So even those who are in by accident, I think get kind of caught up in it all. All right. Well, I promised, we wouldn't have a full-on crypto conversation here. I do want because you've been publishing some stuff about it, and we definitely want to talk a little bit about that at the tail end. But do want to really hone in on some of like how we got to these separately managed accounts and the individualization. You. I should
Yeah,
stop talking and
that's
just
funny.
let you run with it. You've done a decorated background of it all.
Yeah. Yeah. So, if we're thinking of investment vehicles, I think that it really starts in 1774. So, believe it or not, the world's first mutual fund was launched in 1774 by this Dutch broker named Abraham van Ketwich. And it was, to be clear, like a closed-end mutual fund, but still a mutual fund. The first open mutual fund was 1924. I think that was the Massachusetts Investment Trust or whatever. So in 1774, what had happened is the summer before, so 73, the British East India Company had its share price had tanked. I mean, like catastrophically plummeted in the summer of 73. And the British banks obviously were heavily exposed. I mean, the British East India Company, for anyone who hasn't read much about it, the kind of, I guess, slogan or unofficial description of the East India
Oh,
Company
wow.
was that it was an empire within an empire, because it was essentially ruling India for like a century. And this was a private company with like an office in London. And it was, I think it had at one point like a larger standing army than many countries. And this is just a private company. And so it's an insane organization. But because it was kind of like the pride of Britain, investors and banks, the whole kind of system was, even the government was heavily linked to the British East India Company. And by that, their share price and financial kind of success, or commercial success rather. And so in the summer of 73, when the share price plummeted, British banks suffered heavily. But also in this time, the Dutch in the 17th and 18th centuries were the like they were the hub of financial innovation. The Dutch kind of like financial revolution then spread to other countries, but it was really, everything started in Amsterdam. First stock exchange, 1609, first IPO, the Dutch East India Company. Kind of everything starts with financial history in Holland. And so all of these Dutch banks were also heavily exposed to the price of the British East India Company stock. So when that fell, there were many banks that were either brought to bankruptcy or brought to the verge of bankruptcy, and it really shook like the whole Dutch financial system. And one of the lessons was, okay, these banks and investors more broadly were way too exposed to the British East India Company's stock price, and the company in general, they were not diversified at all. Like they were way too concentrated with their risk exposures. And so the other problem though is that for the average investor, it was pretty difficult to diversify because of the cost of buying shares, and buying bonds. You know, there were no like fractional trading. You had to buy the whole thing, and it cost a lot of money. And so many people couldn't actually diversify. So you ended up in a situation where they might own like only British East India Company stock that plummets, and then they're screwed. And so this Dutch broker, Abraham van Ketwich, recognizes this, and obviously he's not doing it just completely altruistically. He realizes there's a business opportunity here, but he does recognize that there is no great way for the retail investor to diversify their portfolio. And so he comes up with this early mutual fund idea. And so I'm not going to attempt the Dutch name, but the name of this fund, launched in 1774, translates to the Unity Creates Strength Fund, which is a pretty amazing name for the first mutual fund, especially because the portfolio consisted of like 50 bonds that were all equally weighted. And so Unity Creates Strength, a bunch of equally weighted. That's pretty good name, pretty good marketing. And so again, he packaged a portfolio together and then sold shares of that portfolio to smaller retail investors, so that like a mutual fund today, they could buy a share and then get proportional representation of 50 bonds instead of having to, I can't remember what it was, but it was something, it was like 10,000 times more expensive to like buy every bond that seems high, but it was ridiculously high multiple of price, like compared to buying one share of the fund versus if you tried to replicate everything yourself. 10,000, that's way too high, but it was very high. And it was like prohibitively, there's no chance anyone could buy all those shares unless they were wealthy. And the fund was popular. It had some quirks to it, which are also interesting. So the first is that essentially, when you think about it, it was an equally weighted passive bond fund. That's essentially what it was. It had different categories of bonds. Like there were some, I don't know, like turnpike bonds, like other kind of muni-esque investments. And then there were more traditional like corporate bonds. But you had broad,
that's
kind of
competitive
range
with
in
any given bond
investments in
fund
the
today.
portfolio.
Yeah.
Like today, the fee on this passive bond fund was only 20 basis points, which is pretty crazy. Because I think that would be, compared to like the ag or something, a little higher, but overall that's a pretty damn good expense ratio for a 1700s. Yeah. If you think about like what mutual funds, I didn't even think, I was thinking of ETFs. If you compare to a mutual fund, it's probably right about there. And so that was one interesting component. The other was that it had like a share buyback scheme, which is kind of interesting, like this lottery component, which I think was Van Ketwich like catering to human behavior, like knowing something about that lottery, like, oh, this is more exciting than just, owning some turnpike bonds, which is not very sexy. It made it really interesting because essentially like this lottery system would choose certain shares. I don't know what the basis was, like annually or whatever. And Van Ketwich would buy out that person's shares at like a preset premium. And so it was like, oh, you won the lottery, you get to get out at a premium. And then after that, more of the earnings and income from the bonds like went to a smaller pool. So it benefited them. But it was kind of just an interesting little quirk. The other interesting angle on this fund was that to avoid over trading and any kind of nefarious actions by the portfolio managers, which there were three, the managers locked all of the bond certificates into an iron chest with 3 locks, so that if any kind of decision was going to be made, because buying and selling required having the actual paper, all 3 managers would have to be in agreement, because otherwise they couldn't open the lockbox. So I thought that was pretty interesting approach to kind of limiting the active decision making, because there was the understanding over trading will lead to subpar performance, and so set and forget, offer this low cost fund and let's go get some investors. So that was the first passive bond fund. 5 years later, Abraham Van Ketwich reinvents himself as the first value investor. Not the first value investor, but definitely the first value fund offerer. Doesn't flow as nicely. But in 1779, he launches his second fund, which is like Concordia Pass Crescent or something. I don't remember what that translates to, but in the prospectus, the fund's objective was specifically stated as buying securities below their intrinsic value, for which we have like every reason to expect something like positive outcomes. But it was explicitly stated, we're buying securities under their intrinsic value and going to sell them when they trend above. So pretty impressive. That is certainly the world's first value fund. And same guy, not bet too shabby. So that was 1779. And then honestly, it was pretty quiet for a while. 1792 is when shares of, or when like the Buttonwood Agreement in the US is signed, leading to the creation of Wall Street, and the kind of American market gets underway. The first crisis is in 1792 because this guy, William Dewar in the Treasury, was doing some insider trading, much to the annoyance of Alexander Hamilton. And there was some sketchy things, the Bank of the United States going public, et cetera. But that was kind of the next big thing in terms of our American markets. But it wasn't until I'd say 1868 that the first investment trust, the first emerging markets, at least investment trust, was launched. And it was launched in London. And the name of the fund was the Foreign and Colonial Government Trust, which actually still exists today. I want to say that Aberdeen owns the fund that traces back. All I know is that it's like still in operation today under some massive firm's umbrella, but pretty cool. And so this fund was large, or this trust was largely possible. Well, really only was possible because of the technology that had advanced since the mutual fund days, because, Van Ketwich's fund was very local. Here's some Dutch and European bonds. We'll package it together and you can invest in this passive fund. Even with the value fund 5 years later, that was focused very regionally. Whereas in the time between there, a lot changed. Railways, 1820s, 1830s, first railway mania is in the 1830s and 40s. You get, alongside the expansion of railways, the expansion of telegraph cables and communication technology. And so as these rail lines are getting laid, there's cables alongside it that's helping communicate messages. But then also, I think in 1844 is when the telegraph cable is laid internationally, I want to say. And so suddenly we can easily, relatively easily communicate information from London, New York, other parts of the world, whereas previously there was, you would get the information at such a lag, it was almost impossible to really invest. So that technology enabled Foreign and Colonial Government Trust to found an emerging markets focused fund that was not only emerging markets, but international, and mainly emerging because it was all the countries within the British Empire. Hence why it's called the Foreign and Colonial Government Trust. And so it was wildly popular at the time because when yields were low in the UK on consul bonds, which is their equivalent of like long-term treasuries, British investors could go and invest in this foreign and colonial fund and access the bonds in countries like, like Chile, which were yielding like 20% because it was much riskier. And so it was a no-brainer. There was this whole craze. There were many crazes for like emerging market Latin American debt in England in the 19th century. In the 1820s, British investors were so enthusiastic about all these Latin American countries that had gained independence from Spain, so could now be traded with, that they just started sending all these goods to Latin America, regardless of whether it made sense for that market or not. Like there was a company in Sheffield that was sending ice skates to like Argentina, and it's like, or like somewhere that doesn't even have any like mountains or like cool ranges. And it's just like, yeah, I don't think this is it, buddy. I don't think this is your next market. But it just kind of captures that like just craze. It's kind of just like, wow, this is like every time one of these regions kind of became online, as it were, because of technology, and we could communicate, learn information about it, transmit information easily. People just got so enthusiastic because it was like each time, wow, this is like a paradise. This is going to change everything. But so that technology really led to the creation of the first foreign investment trusts, which became wildly popular. And that trust form kind of evolved over time. And the next kind of major, I'd say, innovation, especially with these trusts, I already mentioned the first open mutual fund in 1924. But in the 1920s, there was a movement called the fixed trust movement, which kind of like Van Ketwich's first fund was designed to give investors access to a fund with a fixed list of securities in the prospectus. So that's where the fixed comes from. And that fixed list was essentially just the index, and you could buy shares in that index like you would with a mutual fund or ETF today. What was interesting is that over time, these funds started to have many different iterations. One of them was called like a fixity trust. I don't know why they called it that, but before long, what started as a fixed trust fund would over time kind of evolve into the fund managers would start sprinkling in like a little bit more active decisions to the fund strategy. And then there were even some cases where what would start as a passive fixed trust would then after like 5 years convert into an actively managed trust with higher fees. And so it's kind of this like terrible system where, a firm would say, yeah, come passive index investment. And then a couple years later, just change it and say, psych, it's actually an active, like, high turnover active strategy now. But what was interesting is that after the 29 crash, there was a huge kind of boom in these fixed trusts because there was such a backlash, similar to the 2008 crisis, honestly, how you see really passive assets start really exploding after 2008 because people were just so angry at Wall Street and active management, et cetera. After the 29 crash, there was a huge boom in popularity for these fixed trusts for the exact same reason. There were economist articles talking about fixed trusts being beneficial because they take the kind of human element and active decision-making element out of the equation. And there's some line that was something like, if we're paying investment managers to understand the market and avoid a 29 crash, and we're paying them fees to do that, and then they have worse performance than the market, why are we paying them fees? And so this fixed trust boom is really the first kind of passive investment boom. The trusts had some problems, so they obviously didn't stay, or we would be using them. But it's still an interesting kind of idea or an interesting period because it so closely parallels to what happened after 2008. The other interesting thing is that even in the 1920s, people were concerned, as are some investors today, about there's so many conspiracies on Twitter about this, but just what the potential problems could be where if you have, some giant fund managers like a Vanguard, State Street, BlackRock, et cetera, and they own like all these companies because they own them through their funds, does that cause problems, et cetera? And there's an economist article saying the exact same thing in like 1920 something. So it's just interesting. Again, that's a great example of we always think like we're smarter than the people in history, but as essentially passive ETFs became introduced, they immediately started asking the same questions that people are saying today about what's going to happen when three providers own, like, they're the top three, holders for like every stock in America. And so I found that fascinating. But that was kind of the next big invention. And ironically, one of the companies that was at the heart of supporting this fixed trust movement was the Standard Statistics Company, which, as you might guess, is what became Standard & Poor's, S&P, which obviously has a huge indexing business today. But it's just interesting to see, first time around, they were also big proponents and recognized the value. And there were also some trusts that were essentially smart beta trusts. There were trusts that, instead of just saying, here's the list of securities, there would be like, what do you call it? Kind of like sector trusts where it would say, come buy an index of British industrial firms, and it would give you the list of 15 stocks they were going to buy. And then you knew like this is going to be the 15 we have. What happened was you started having funds that were smart beta or like factor kind of funds where, instead of British industrial firms, it would be British publicly listed firms that have a high dividend yield. And then in their prospectus, they would say kind of what their threshold for high dividend yield is. And then if a company fell below that kind of threshold, then they would swap it with a company meeting whatever criteria they put forth in their prospectus. But again, the investment decisions were predicated on a factor or kind of characteristic of a stock. So very similar to smart beta funds and ETFs today, which I found fascinating. So that was like after that, it's everybody knows, kind of ETFs, et cetera, but that's the kind of early history. And so I think we'll come back to it. But today, the next innovation is custom indexing. So in the 1990s, there was the birth of direct indexing. And so that's instead of owning the S&P 500 ETF, instead of owning SPY, you own the underlying positions, all 500 in an index that you own within a separately managed account, so an SMA account, where instead of your funds being commingled with a bunch of other people's funds, and then you can all own a share of the S&P 500 instead of the 500 companies. With a direct index, you can do that, but then also get the tax benefits of owning the underlying positions. So instead of only being able to sell if the whole S&P 500 is at a loss, you can sell the specific stocks within an index that are at a loss, which helps immensely with tax, your tax bill, because you can lower you can offset your capital gains taxes.
So Jamie, the background that you have given is just fascinating. And at so many points in time, I'm tempted to jump in and dig in further. But the one common thread that I hear in this financial innovation is when technological improvements were made, whether that's laying cable across the oceans or computers or just general corporate structure innovations. Technology is what not only drives some of these solutions, and separately managed accounts have been around, like you said, for quite some time. It's just that the process of managing them have been more manual, which means they were costly, and the minimum investment amounts were quite high. And I think today, with technology being what it is, costs are coming down, minimum investments are coming down. And so as a result, you pick up a paper or go read an investment blog and you hear about direct indexing, and it sounds new. It has been around for a while. And just to kind of differentiate for our audience, I think at a basic level, you, the listener, Jamie, and me, if we're all owning a mutual fund and I decide to sell some shares, the mutual fund's going to go liquidate those shares. You guys are going to be stuck with the capital gains, and I just get my money and walk away. The ETFs were fantastic because if you, listener, Jamie, and myself are all in a fund, when I go to sell, they sell my basket of securities, and they actually filter out a lot of the lowest basis securities in the process so that you all are not held with my behaviors. You're not held with the gains here. This separately managed account is as if we each all had our very own ETF or own mutual fund, professionally managed. And so not only are you not impacted by others' behaviors, but if you own the Russell 3000, there's 3,000 stocks. And I think one of the things that surprised me when we started doing this at Plan Corp in 2017 was in a given up year, what a large percentage of the stocks are down. And it's one thing to tax loss harvest an ETF in a mutual fund. That's great. That happens in down markets. That's making some lemonade out of lemons. When you are able to tax loss harvest in all markets and still earn that market return, that's really powerful. I don't know if I missed anything there that you want to add to or give color to.
Yeah, so I'd say a couple of things. First is that, so the common thread, I would say, linking from 1774 through the fixed trust and even ETFs, the common thread is technology. Usually a technological innovation leading to the creation of a new investment vehicle. And that investment vehicle, while an innovation itself, because it's a new vehicle doing something different than previously, the kind of underlying structure of every single one of those vehicles was a commingled fund. So even though each iteration had something new, like the first trusts were suddenly offering international diversification for investors. still everything was a larger group of investors pooling funds into the same exact portfolio, no customization. So that was kind of the trade-off, was you previously couldn't access these investments really at all because they were too expensive. And now you can, but the only way we can offer that capability to you or offer that access is by restricting your ability to customize. So you just kind of have to live with that. What's exciting about direct indexing and even more custom indexing, which I'll differentiate in a second, is that this is one of the first times, if not the first time, that technology has enabled the creation of a new investment vehicle that still offers the benefits of all the previous funds mentioned, diversification, et cetera, but the ability to customize every client's account individually at scale. So it's easy to think of, if you have 100 clients and I'm telling you, it's great, every one of your 100 clients can have like a different portfolio. That sounds like a nightmare. But the technological innovation, one of the ones that has led to the creation of custom indexing platforms like Canvas, the one that my firm, O'Shaughnessy Asset Management, launched in the end of 2019, is for an asset manager like O'Shaughnessy, especially O'Shaughnessy, because our history is as a quantitative factor investor. So we are very good at computer models and systematic trading, and having all of our accounts, because that's another quirk of OSAM, is that historically we have always been an SMA kind of first asset manager, whereas most firms of our profile would kind of go into the mutual fund ETF suite. And so for like 2 decades, we've already been managing all of our clients' accounts that are invested. I mean, not everyone in the same model, but we'll have like 1,000 clients in our market leaders value strategy or something. Most of those will be in an SMA. And so they're all following our market leaders value model. But because it's all systematically managed, we can just in our software, internal software, make adjustments for these individual accounts, and they will understand that might lead to some tracking error deviation from the overall model. But in terms of managing it, it's very easy because it's just essentially, changing something in the code, and then forever it'll trade the model that way. And so with Canvas and custom indexing, the kind of eureka moment at OSAM was similar to how Amazon Web Services was really just Amazon's internal tools that they used. And then they realized, oh, these are pretty awesome tools. Like I bet other people would be able to get a lot out of this. Let's just make this an external tool that's publicly available, and we'll turn it into a business. Canvas is really, when we launched, was just us building a platform that others could access, and they were accessing the tools that we've used to manage our portfolios and SMA strategies since inception. And so the customization at scale is the big kind of technological advancement. And the difference between direct indexing and custom indexing is, like I mentioned, direct indexing is very much kind of, you can have a very tax efficient version of, and customized version of the S&P 500, but you can get all the tax benefits because you own the underlying shares. Also, if you care a lot about the environment and don't want to own, stocks like Exxon, BP, whatever, then you can exclude those. But it's very kind of siloed. It's, you can think of it as like that's one allocation within your portfolio. You're not building your whole portfolio, your international, domestic, large cap, mid cap, small cap, value, growth, blah, 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 exposures in one direct index. You're getting your passive US large cap exposure direct indexed. Custom indexing is taking the same principles of direct indexing, but applying it to your entire portfolio, should you wish. Obviously, most of our Canvas partners, advisors use it for their whole model, but for something like fixed income, they might do all their equities on Canvas, but still, use an active a fixed income manager. But within a custom index, you can build a portfolio that does offer all of your international US exposures. And then you can, within each of those buckets, decide how much passive and active exposure you want within international mid cap. You can decide I want 52% of international mid cap to be passive, and the 48% I want it to select based on value factor, shareholder yield, dividend yield, what have you. And being able to do that allows you to holistically manage from a tax perspective, but also customization perspective, an entire portfolio, which leads to huge benefits not available in a direct index because it's so siloed. So like for something like ESG right now, you can't really build a whole portfolio with ETFs and mutual funds that adheres to the same ESG philosophy. You might be able to find, well, you can obviously a lot of US centric ESG funds, but if you buy, some like ESG equivalent of the S&P 500, for example, now you have in your portfolio an ESG strategy for your US large cap, but what about the rest of the portfolio? And also, does that US large cap ESG strategy actually apply ESG in the way that you want, or is it one of those virtue signaling ESG ETFs, that says we're carbon free and then like the top 10 holdings has X on in it, and it just makes no sense. So that ESG, if someone wants ESG, I don't think they only care about ESG for large cap US companies. Like they probably care about ESG generally. And so being able to actually build a portfolio and then layer on ESG, SRI, customizations on top of the whole portfolio so that it's applied uniformly is a huge benefit and something that you literally cannot do with a mutual fund or ETF. And you can also, another thing we can do with a custom index is you can really like architect a portfolio. So again, if there's no ETF or mutual fund with the specific kind of ESG policy or topic you care most about, then that's the end of the conversation. Whereas with custom index, we can build that, And so it's a very exciting time. And it's one of those things where in every other industry, we crave personalization over commodification. And so if you just think about the long-term future, like, do you think that people will want less customization or more customization in their investments? And to us, it's a pretty obvious answer. Like if I said, hey, I just got my wedding tux this weekend and I got a custom made one, because it's like, hey, you can buy this one off the shelf and we won't tailor it at all, or you can get one that's specifically made for you. And it's like, obviously I would prefer the latter. And almost every industry, if you think about it over the years, has gone more towards that personalized touch and using technology to be able to offer customization to clients and customers at scale. And now that kind of advancement is finally coming to finance, which is very exciting.
Yeah, and the big piece of it to me is that the cost, while higher than an index ETF, it's not that much higher. It's pretty competitive. And there's a few notes I made as you were speaking. One is that ESG means different things to different people. I know in our ESG models at Plain Corp, that was one of the hardest pieces, was you could build out a basic allocation, but we basically had to define what does it mean to us to be ESG? What does the research suggest is not harmful to clients? But using a separately managed account, or an SMA, as we say, to address more specific ESG issues is one of the most common use cases that we've had since using these strategies. And I agree that going forward, people can have very specific wants and needs in their portfolio, whether it's DE&I initiatives, or fossil fuels, or weaponry, or gender diversity at the board level. There's any sort of degree of customization. And I must pay Canvas a compliment as someone who does due diligence on all the different options out there. Your platform, it is abundantly clear that you turned your own internal tools outward facing because you can see how those little tweaks end up impacting the portfolio. And so what these SMAs allow an advisor like myself or those at PlanCorp to do is to not only build you something personalized, but really build something that meets your objectives and goals, both financially. So if we're trying to do something beyond index funds, and whether that's overweight towards cheap companies, and hey, we don't have to be subject to one person's definition of value. We can define that value. So the customization is not just at the client level, but the advisor level. And I think these use cases, we're talking about ESG, we talk about it's a tax efficient way to get broad market exposure or specific exposure. It's a great way to customize your exposure if you have equity comp or you're an executive of a company and you really need to maintain like your human capital and sometimes your biggest asset are all tied to one industry or one company. It's a tremendous use case. The one question I have for you, and there probably isn't a right answer, is this degree of customization and tools like you've built, like Canvas. They're advisor facing today. Someday, I suspect it'll make it to retail where somebody is going on a website and designing their own portfolio. Do you think that is in the near future, in the intermediate term? I mean, when do you think we get to that point?
I don't. I think long term that it'll definitely end up there, but I don't think it'll be anytime soon. Just because there's so much that goes on the back end. I mean, if like a company wanted to start from scratch today, it'd be very difficult. The reason that we were able to do it in relatively short order was because it was really just building the platform to get at. When we first launched, we're constantly launching new features, strategies, which is the other cool part of a platform approach is, we might build something for one of our partner firms and then assuming that it's not something specific to them and their firm, we can then offer that we can just build it into the platform generally so that all the other kind of members of the platform community benefit. And so that's another interesting angle instead of just, buying an OSAM mutual fund and that being it. With the Canvas platform, like you get to benefit from all of the other users. So it's kind of interesting, like everything's additive.
So Jamie, this has been a really great conversation in general, definitely touching on some of the stuff that I was hoping we would talk about. One other thing before I let you go that I want to talk a little bit is about just bubbles in general. You have 2 courses on your website, Investor Amnesia, that I'll link to in the show notes, one on empires, one on bubbles. I don't know that I have enough time to hit both. So why don't we focus in on bubbles? What are some of the lessons that we can learn from the past looking at those instances?
So there's so much. I guess to get more specific, I'll relate it to, because there's so many ways I could go with a bubble question. But one of the ways I think I have found most interesting recently is in relation to FTX and their just implosion, explosion, whatever you want to call it. And it's emblematic of a larger theme in financial history, which is that you tend to see the fraud or alleged fraud cycle, shout out compliance officer, at FTX, and the market cycle. And so by that, I mean, you tend to find like fraudulent or poorly and sketchily run companies tend to be exposed in the aftermath of a bubble being pricked. So for anyone that watched the new Bernie Madoff documentary on Netflix, you'll see that it was 2008 that stuff started to come out more broadly, where he had been able to kind of keep his scam going for decades. But when markets tighten up and things become more fragile, it's harder to cover up what you're doing, cover up the fraud. Enron after the dot-com collapse, a billion companies after the 29 crash. And again, you just see this kind of pattern repeat throughout history. And so with FTX, it's less I mean, crypto has been just getting pummeled, I feel like, for a little while now, obviously more so after the FTX debacle. But in hindsight, it's funny to look at how favorably everyone viewed Sam Bankman-Fried and FTX before the crash, because prices were still good. You know, there's not really, when people are making money and things are going well, there's less of a reason to question it, because who wants to find out the bad information, you know? Whereas when things are bad, that's when people start to really investigate what's going on, because then they want to get their money back. And so after FTX collapsed, that's when we see now what was going on this whole time. And we probably would have been more scrupulous about had we known what the end was going to be, instead of just assuming it'll be rosy forever. Now it'll be interesting to see what regulation comes into place, because after the cycle you tend to see is there's a bubble in something new and exciting, hence why there's the bubble, because people think that, again, taking it back to full circle, they think that this new innovation is going to change everything, etc. And so then after that bubble gets pricked, and there's usually a company like, or a person like Bernie Madoff's fund after 2008, etc., then you get a lot of regulation put in place, because there's such a backlash to the bubble popping and people losing money and whatever this new innovation was. And specifically a high profile company or person being outed as a fraud, or their company going under because of speculative bets that they made during the market run up. So one of the examples that I actually just wrote about last weekend was in the years leading up to the 29 crash, there's this guy, Samuel Insull, who built a utility empire. I mean, the reason that utilities today are that kind of like weird regulated monopoly status where they're public companies, but they're heavily controlled by the government, that system is all traced back to this guy, Samuel Insull, because he built a utility holding company that, like, his empire spanned like 32 states or something. He was just buying utility companies like left and right. And he had this big like pyramid structure and offered juicy dividends and returns. And like everything though was very predicated on the smaller utility companies like funneling up stuff to be able to pay these dividends, etc. And as part of this kind of empire building process, the leverage got to insane amounts. I think it was like 27 million in equity and like 500 million in assets or something, or liabilities rather. And it's just nuts. And so it only would take a very modest decline in the market for the empire to blow up. And of course, there's always a quote. It's like with Trump, people say there's always a tweet, like something he said previously about whatever, crazy news stories going on. Samuel Insull said, yes, a moderate decline would take us out, but the idea of a decline in utilities companies that would hurt the industry occurring are inconceivable. It's like, well, pretty conceivable, because lo and behold, 29 crash happens. His empire is just razed to the ground. And I think something like 600,000 investors were completely wiped out. And 500,000 bondholders. So kind of like FTX, people just like, it just wrecked people's holdings. Afterwards, as part of the New Deal legislation, which obviously is like the biggest, most all-encompassing probably regulation in the US for maybe ever. As part of that, FDR used Samuel Insull as an example in his speeches and kind of his stump tour about, as an example of why we needed greater regulation. And so the Public Utilities Holding Company Act of 1935 was in direct response to this Samuel Insull empire and collapse and the bad practices that he had implemented in the buildup, which led to the catastrophic knock-on effects of his empire's collapse, like overly leveraged, etc. And so that very stringent regulation was put in place because of his run up and collapse. And Samuel Insull at the time, there's a quote I put in the article of this guy, his biographer said that he was like the Babe Ruth, and he named some famous Hollywood actor of the day. Like people used to call Chicago like Insulopolis because he had such a presence. And so he was like the equivalent of a SBF, but for utilities. And so it's going to be interesting to see today if, like after 2008, you have Dodd-Frank, et cetera. After 29 crash, you had, I mean, the SEC Act, the Securities Act, and then also this Utilities Act. It'll be interesting to see after the FTX blow up whether there is going to be now a wave of more stringent regulation finally in crypto to avoid an FTX situation occurring again. Because it's one of those things where it's obvious political win for the politicians and regulators to say that they're going to make sure something like this never happens again. And also the financial system wants to make sure that doesn't happen again because there are serious knock-on effects. What's interesting is obviously that this is all happening within crypto, which is the asset designed to not be regulated by the government. And then suddenly, though, when FTX goes under, a lot of decentralization advocates are clamoring for centralization so that they can get their money back or some kind of, retribution for the money they lost due to FTX's mismanagement and alleged fraud. So it'll be interesting to see, but there's definitely that pattern throughout history of a bubble, high profile collapse, really tough regulation instituted, much of which still influences how markets operate today.
It's pretty wild that Bernie Madoff wasn't that long ago, and before that, Enron, and you just like general fraud. It's a constant theme throughout our conversation. We have been here before. I don't know if it'll take 10 years or 15 years or 20 years to have our next fraud, and then there'll be a whole set of regulations for that to, sort of make, like you said, the politicians feel good about stamping out something that was a bubble perhaps at one point, or perhaps was too good to be true. Well, Jamie, I've taken a lot of your time. I know you have to be somewhere here shortly. So real quickly before you go, though, I've mentioned the website Investor Amnesia a few times. Where else can people find you if they want to follow you?
Yeah, so on Twitter, I am Investor Amnesia. The newsletter, if you'd like to subscribe to it, that is also on my website. So if you just go to investoramnesia.com, you can sign up. It goes out every Sunday morning, put market events into historical context. And you can also find both the courses that you mentioned on my website. So there's one on the history of bubbles that has lectures from people like Jim Chanos, William Getzman from Yale, Scott Nations, who wrote a great book and is also a CNBC contributor. And then the second course is on empires and like the financial history of both corporate and sovereign empires. So, and looking how kind of politics plays into that. So given all the sanctions stuff with Russia, that's been a course that's become much more relevant. And that has interviews and lectures from people like Neil Ferguson, Mark Andreessen, Tracy Alloway, a lot of people. It's great course, very informative. I say that not only because I am the one offering it, but because of the amazing lecturers that graciously participated in the course. So I'd encourage everyone to go check it out. And yeah, thank you again for having me, and hope the listeners subscribe to Investor Amnesia. Yeah,
well, I'll definitely keep and put everything. We reference so much stuff. It'll all be at thelongterminvestor.com. I have taken the Bubbles course. I can personally say it was awesome. I've not done the Empires one. I probably should sooner than later. If you are watching us on YouTube, comment below for when I beg Jamie to come on next, what kind of history you want us to talk about. And same in Apple or Spotify. If you leave us a review, tell us what you want to learn more in history about. I really appreciate the time. For everyone watching and listening, thanks as always. And until next time, to long-term investing.